Ever wondered how a single tulip bulb could cost as much as a house? Picture it, 17th century Holland, a time when a fervor for tulip bulbs swept the nation, causing prices to skyrocket inexplicably and abruptly. This phenomenon, known today as Tulip Mania, was the first recorded instance of what we now call a market bubble. These bubbles are not made of soap and water but of hype, speculation, and the tantalizing prospect of immense wealth. They inflate, growing bigger and bigger until, pop! The bubble bursts, prices plummet, and economies are left in turmoil. Market bubbles, though destructive, are undeniably fascinating. They represent the collective psychology of investors, a mass delusion fueled by the promise of easy money. From the tulip fields of Holland to the tech startups of Silicon Valley, these bubbles have shaped history in unexpected ways. Today we dive into the fascinating world of market bubbles, starting from the famous Tulip Mania to the dot-com bubble. In the 17th century, the Dutch were gripped by what we now know as the first recorded market bubble, the Tulip Mania. Imagine a world where a single flower bulb is worth as much as a luxurious house. Sounds ludicrous, doesn't it? But that was the reality of the Dutch Golden Age during the early 17th century. This period saw the rise of the Tulip Mania, a phenomenon that was nothing short of extraordinary. Tulips were introduced to the Dutch from Turkey around the late 16th century. Their exotic beauty and uniqueness quickly made them a status symbol among the Dutch elite. As demand grew, so did the prices. The tulip trade transitioned from a hobby to a lucrative business. By the mid-1630s, the tulip market had turned speculative. People were buying tulip bulbs not for their beauty, but for the quick profit they could make by reselling them. This led to a frenzied buying spree, inflating the prices even further. At the height of the mania, in 1637, a single tulip bulb could cost as much as a grand canal house in Amsterdam. But as we know, what goes up must come down. And so it happened with the tulip market. The prices reached a point where no one was willing to buy anymore. Almost overnight, the market crashed. Those who had invested their life savings into tulips were left bankrupt. The economic consequence was a severe depression that lasted for several years. The Dutch government had to step in and introduce regulations to stabilize the economy. But the tulip mania was more than an economic crisis. It was a stark reminder of the irrational behavior of investors and the speculative nature of markets. People were buying tulips not because they valued them, but because they believed someone else would pay even more for them. This speculative buying behavior is a characteristic feature of all market bubbles. Thus, the tulip mania became a classic example of a market bubble, setting the stage for many more to come. Fast forward to the 18th century, and we encounter another significant market bubble, the South Sea Bubble. This economic phenomenon took place in Britain and involved the South Sea Company, a venture that held a seemingly lucrative monopoly over trade with the South Seas. The company was established in the early 1700s with a grand vision of wealth and prosperity from overseas trade, particularly with Spanish colonies in South America. The British government, grappling with substantial war debts, saw the South Sea Company as a promising solution. In exchange for taking on the government's debt, the company was granted exclusive trading rights in the South Seas. Investors, enticed by the allure of vast riches from this uncharted territory, poured their money into the company. The share prices soared, creating an investment frenzy that seemed unstoppable. But beneath the surface, the company was not nearly as profitable as it had appeared. In fact, it was making very little money from its South Seas trade. The illusion of prosperity couldn't last forever. In 1720, the bubble burst. The company's share price plummeted, leaving many investors with significant losses. This crash wasn't just a blow to individual fortunes, it sent shockwaves through the British economy. The government, which had tied its debt to the company, found itself in a precarious financial position. The South Sea Bubble's burst led to an economic depression and public outcry. It resulted in stricter regulations for joint stock companies and a more cautious approach to speculative investments. In the aftermath, it became clear that the bubble had been driven more by irrational exuberance and speculative frenzy than by the actual value of the South Sea Company. The South Sea Bubble, like its predecessor, left a wake of economic devastation, further demonstrating the destructive potential of market bubbles. But it also provided a crucial lesson: the dangers of speculation and the importance of a more measured approach to investing. As we'll see in our next segment, however, these lessons are often forgotten in the heat of a booming market. Let's leap to the turn of the 21st century, where the dot-com bubble took the world by storm. As the millennium approached, the world was captivated by the rise of the internet. Suddenly, everyone was connected, and the possibilities seemed endless. This new frontier of communication and commerce gave birth to a multitude of internet-based companies, often referred to as dot-coms. Investors, eager to get in on the ground floor of the next big thing, poured money into these startups. But not all that glitters is gold. Many of these companies, despite having high stock values, were not turning a profit. They were running on speculative investments, with investors betting on their future success. This created a volatile market environment ripe for a bubble, and bubble it did. By the year 2000, the market began to correct itself. Investors started to realize that many dot-coms lacked a sustainable business model. The realization was like a pin to the inflated bubble. Stock values plummeted, investors scrambled to sell, leading to a mass exodus from the tech sector. This rapid sell-off resulted in a market crash known as the dot-com bust. Many of these once promising internet companies folded, unable to sustain themselves in the harsh reality of the market correction. The repercussions were widespread. The tech sector was decimated, with companies losing billions in market capitalization. The fallout was felt across the globe, with economies worldwide feeling the impact of the burst bubble. But amidst the economic turmoil, there was a silver lining. The dot-com bubble served as a wake-up call. It highlighted the dangers of speculative investing and the importance of sustainable business models. The echoes of the Tulip Mania could be heard in the downfall of the dot-com bubble. Centuries apart yet strikingly similar, both served as stark reminders of the dangers of market speculation. The dot-com bubble served as a stark reminder of the Tulip Mania centuries later, proving that even the most modern markets are not immune to bubbles. History, as they say, often repeats itself, and the case of market bubbles is no different. The stories of Tulip Mania, the South Sea bubble, and the dot-com bubble all hold striking similarities. They serve as stark reminders of the dangers that lurk in the financial markets, even today. Each of these bubbles was born out of a unique set of circumstances, but they all share a common thread. They were driven by rampant speculation and irrational behavior. In the case of Tulip Mania, the frenzy was fueled by the allure of a new exotic good, the tulip bulb. This was mirrored in the dot-com bubble, where the novelty of the internet drove investors to pour money into technology companies, regardless of their profitability or even the viability of their business models. The South Sea bubble, on the other hand, was a more classic case of stock market speculation. Investors were enticed by the promise of untold riches from trade with the South Seas, leading to a buying frenzy that drove up stock prices to unsustainable levels. But no matter how they start, all bubbles have one thing in common: they burst. And when they do, the fallout can be catastrophic. The aftermath of each of these historical bubbles was marked by financial ruin for many, and economic downturns that lasted for years. Yet, amidst the wreckage, there are valuable lessons to be learned. The first is the importance of rational decision-making. It's easy to get swept up in the excitement of a booming market, but it's crucial to stay grounded and make investment decisions based on sound fundamentals, not hype or speculation. Secondly, we must remember that what goes up must come down. No market can rise indefinitely, and when prices become detached from underlying value, a correction is inevitable. Finally, history teaches us the value of diversification. By spreading investments across different sectors and asset classes, we can insulate ourselves from the worst effects of a market crash. By understanding these historical bubbles, we can better equip ourselves to navigate the complex world of investing and hopefully avoid the next big crash. In the end, market bubbles are a fascinating, if dangerous, aspect of economic history. From the rare tulips that captivated 17th century Holland, to the exotic allure of the South Sea Company in the 18th century, to the heady days of the dot-com bubble at the turn of the 21st century. These episodes serve as stark reminders of the perils of speculation and the allure of quick riches. Yet they also underscore the resilience of economies, their ability to bounce back from periods of irrational exuberance and financial malaise. These market bubbles, while devastating in their immediate aftermath, have invariably paved the way for new periods of growth and innovation. Understanding market bubbles is not merely an exercise in historical curiosity, it's a vital tool for navigating the financial landscapes of today and tomorrow. So next time you hear about a skyrocketing asset, remember the tulips and tread with caution. After all, what goes up must come down.